In 1999, a man named Harry Hoxsey put his entire life savings into the stock market. He was a teacher, 43 years old. He had been careful his whole life, paid off his house early, never borrowed more than he needed. And then, one evening, his brother-in-law showed him a chart, just a chart, a line going up and to the right for 4 straight years. And Harry thought, I've been doing this wrong my whole life. By the end of 2000, Harry had lost 63% of everything he had. He wasn't stupid. He wasn't reckless. He was doing exactly what millions of people were doing at that exact moment in history. He was following a feeling. He was looking at something that had worked and assuming it would keep working. He was investing. Here's the thing about investing that nobody says out loud. Most people who try it lose money. Not all of them, not forever, but most people, most of the time, underperform a strategy so boring you could explain it to a child in 4 seconds. And yet the industry built around investing, the analysts, the newsletters, the apps with the confetti animations when you buy a stock, none of them make money when you're doing the boring thing. They make money when you're active, when you're scared, when you're chasing. So today, we're going to talk about 5 rules. Not tips, not hacks, rules. The kind that actually separate people who build wealth through the market from people who just think they are. Some of them will feel obvious. That's how you know they're real. The obvious things are the hardest to follow. Let's get into it. Before we get into the 5 rules, one quick thing. This is Signal Mark Capital. Every week, we publish one video. Not daily, not hourly. One. Because good investing doesn't require more information. It requires better information, properly understood. Each week, we take one concept that determines whether investors actually build wealth over time. The kind of concept that gets buried under market noise, oversimplified in headlines, or conveniently ignored by people who profit from your confusion. And we break it down completely, with data, with historical context, with the uncomfortable parts included. That's what subscribing to Signal Mark Capital gets you. One focused, evidence-based breakdown every week. No filler, no ticker chasing, no hype cycles. If that's the kind of clarity you're looking for, subscribe now and hit the notification bell. The algorithm won't surface this channel reliably unless you tell it to. That's just how it works. All right, 5 rules. Let's go. Rule 1. Understand what you're actually buying. Most people think they understand what a stock is. They don't. Ask someone what they just bought when they buy a share of Apple, and they'll say something like a piece of the company. And that's technically correct, in the way that saying the ocean is a bit of water is technically correct. Here is the fuller picture. When you buy a share of stock, you are buying a claim on future earnings, not past earnings, not current earnings, future earnings. You are making a bet, a calibrated, hopefully rational bet, that a specific business will generate more cash in the future than the market currently expects. That's it. That's the whole game. Everything else, the charts, the analyst ratings, the CNBC segment at 9 a.m., is noise layered on top of that one fundamental question. Will this business earn more money in the future than people currently think? Why does this matter? Because it completely reframes what you should be looking at when you research a company. Most new investors look at price. They see a stock that was $200 6 months ago and is now $150. It feels cheap. It feels like a sale. But price is not value. Price is just the last thing 2 people agreed on. Value is something you have to figure out for yourself. A stock can fall from $200 to $150 and still be wildly overpriced.
It can also fall from $200 to $150 and be a screaming bargain. The price tells you almost nothing by itself. This is what Benjamin Graham, the man who taught Warren Buffett how to invest, called Mr. Market. He said, imagine the market as a business partner who shows up every single day and offers to buy your shares or sell you his. Some days, Mr. Market is euphoric and his prices are insane. Other days, he's terrified and his prices are irrationally low. Your job isn't to follow his mood. Your job is to know what the business is actually worth and only trade with Mr. Market when his prices make sense. Most investors do the opposite. They follow Mr. Market's mood exactly. When he's excited, they get excited. When he panics, they panic. They let a fictional emotional partner dictate their financial decisions.
The antidote is simple, but not easy. Before you buy a single share of anything, you need to be able to answer 3 questions. What does this company actually do to make money? Not in a vague sense, specifically, where does the revenue come from? Why will it earn more money in 5 years than it does today? What's the engine of growth? And what could go wrong? Not in a catastrophic asteroid hits Earth sense. Realistic things, competition, regulation, a technology shift, a change in consumer behavior. If you can answer all 3 questions clearly and honestly, you're already ahead of a significant portion of retail investors. If you can't, you're not investing, you're guessing, and the market charges a steep fee for guessing. Rule 2. Price is what you pay. Value is what you get. In 2007, a company called Research in Motion was the hottest stock on the planet. BlackBerry. You remember BlackBerry. Every executive had one. The president had one. They called it Crackberry because nobody could put it down. The stock was trading at about $145 a share at its peak. Its price-to-earnings ratio, the multiple the market was willing to pay for each dollar of the company's profit, was around 50 times earnings. In 2012, the stock was trading at $7. Nothing fraudulent happened. The company didn't collapse overnight. It simply stopped growing the way the market assumed it would. It got outcompeted. And the people who bought it at $145 paid a price that only made sense in one very specific, very optimistic scenario that never came to pass. This is the silent killer of investing returns: overpaying. You can identify the right company, the right industry, the right management team, and still lose money if you pay too much, because the price you pay determines your return, always. Here's the math. Suppose a company earns $1 per share. If you pay $10 for it, 10 times earnings, and the company earns the same $1 per share for the next decade with no growth, you've essentially bought a 10% annual return from earnings alone. Now suppose you pay $100 for the same company at the same $1 in earnings. That's 100 times earnings. For you to get a reasonable return, the company now needs to grow dramatically. It needs to justify that price through explosive future performance. And if it doesn't, if it just grows at a moderate pace, you might make nothing for years, or you might lose money, even as the underlying business does just fine. This is what happened to investors who bought great companies at peak valuations during the dot-com bubble. Many of those companies survived. Some of them thrived: Cisco, Amazon, Intel. But investors who paid peak prices in early 2000 waited over a decade in some cases before breaking even. The margin of safety, the gap between what something is worth and what you paid for it, is what lets you survive the something. And things always go wrong eventually. Not catastrophically, just not exactly as planned. The wider that gap between value and price,
the more protected you are when reality diverges from the optimistic scenario, and it always diverges. Sometimes a little, sometimes a lot, but always. Rule 3. Diversification is not about owning more stocks. There's a myth in investing that diversification means owning a lot of stocks. The more, the safer. Spread the risk. Cover your bases. That's not what diversification actually means, and the confusion costs people real money. Real diversification is about owning things that don't behave the same way at the same time. Here's the problem with owning 50 stocks if all 50 are American technology companies. When the tech sector sells off, all 50 of them sell off together. You own 50 positions, but you have approximately one risk. You've created the illusion of diversification while concentrating your exposure. This is not theoretical. In 2022, growth technology stocks as a category fell between 40 and 80%. Investors who thought they were diversified because they owned both Shopify and Netflix and Zoom and Palantir discovered that the correlations between those positions were extremely high. When the macro environment turned, they all turned together. True diversification runs across asset classes, stocks and bonds, domestic and international, growth and value, large cap and small cap. It runs across industries that respond differently to the same economic events. Energy companies and tech companies have different sensitivity to interest rate changes. Consumer staples behave differently in recessions than consumer discretionary. Real estate investment trusts have their own rhythms. None of these categories move perfectly opposite to each other. The point isn't to eliminate volatility. That's not possible. The point is that when your portfolio has genuinely uncorrelated assets, the bad years become less catastrophic. You lose something in every down environment, but you don't lose everything. Here's where it gets slightly uncomfortable. True diversification also means accepting average returns in your best performing position. If half your portfolio is in things that go up slowly, while your best stock doubles, your overall return looks mediocre, even though you did everything right. And that feeling, watching your best idea get diluted by your slower holdings, tempts people to concentrate. This is the psychological trap. Diversification works until it's annoying, and then people stop doing it. The other thing nobody tells you, there's a point past which more diversification does almost nothing. Research suggests that somewhere around 20 to 30 stocks, chosen across genuinely different industries and geographies, captures most of the risk reduction benefits of a larger portfolio. Beyond that, you're mostly increasing complexity without reducing risk. The simpler version, and the one most financial economists genuinely endorse, a globally diversified index fund captures virtually all the market's return with genuine diversification built in. Not as exciting as stock picking. That's the point. We're halfway through. Before Rule 4, one moment. If you're finding this useful, here's what subscribing to Signal Mark Capital actually gets you. Every single week, not when something trending, not when the market crashes and everyone suddenly wants to explain it. Every week, we publish one breakdown, one concept, fully examined. The kind of thing that changes how you read a balance sheet, or understand a Fed decision, or evaluate whether a stock is cheap or just falling. Over a year, that's 52 frameworks, 52 pieces of the puzzle that most investors never bothered to build. That's what the subscription is, not a feed, a curriculum. Subscribe now if you haven't. It takes 3 seconds, and it's the only way to make sure you don't miss what comes next week. Rule 4. This one is personal. Rule 4. Your biggest enemy is you. In 2020, during the sharpest stock market crash in modern history, the COVID crash, which took the market down 34% in 33 days, individual retail investors did something interesting. They bought at a scale the industry had never seen. Robinhood added 3 million new accounts in the first quarter of 2020. People were sitting at home with stimulus checks, with time on their hands, and they watched stocks fall, and they decided to step in. And it worked. The market recovered spectacularly. The investors who bought in March 2020 and held made extraordinary returns. Then something else happened. Over the following 2 years, those same investors, or many of them, began trading more actively. They learned about options. They chased meme stocks. They bought cryptocurrency at its peak. They levered up. And by 2022, when markets fell sharply, many of the gains from 2020 were gone. It wasn't the market that got them. The market did what it always does. It went up, it went down, it went up again. What got them was behavior, their own behavior. Over the 20 years ending in 2022, the S&P 500 returned about 9.8% annually. The average equity investor returned around 6.8%. 3 full percentage points per year lost. Not to fees, not to bad stock picks. Lost to timing, to emotional buying and selling. And it compounds. Over 20 years, $100,000 growing at 9.8% becomes roughly $648,000. At 6.8%, it becomes about $368,000. The same market, 2 very different bank accounts. The behaviors that kill returns follow a predictable pattern. You sell after a crash because you can no longer tolerate watching your portfolio fall. You buy after a rally because you can no longer tolerate other people get rich. You check your portfolio every day, which increases the frequency of experiencing losses. Losses feel worse than equivalent gains feel good, and that emotional exposure degrades your decision-making. The fix is not to become emotionless. You can't. The fix is process. Having a written investment plan that specifies what you'll do under different conditions before those conditions arrive removes the moment of emotional decision-making. Your future self, in a panic or in euphoria, will not make good decisions. Your present self, calm and clear-headed, can make those decisions in advance and lock them in. Automate your contributions. Rebalance on a schedule, not in response to what's happening. Write down your investment thesis for each holding, so you have to actively contradict yourself in writing before you sell. The market is not your enemy. You are. Rule 5. Time in the market beats timing the market. In 1986, a study was published in the Financial Analyst's Journal that would become one of the most cited papers in investment history. It was called Determinants of Portfolio Performance. The researchers found that roughly 90% of the variation in long-term portfolio returns came not from stock selection or market timing, but from asset allocation. The basic decision of what kinds of things to own and for how long. People spend enormous amounts of energy on the 10%. They read earnings reports, follow analyst upgrades, watch technical chart patterns, listen to quarterly conference calls. And all of that activity, most of it, moves the needle on a factor that explains less than 10% of long-term returns. The 90% comes from being in the market, consistently, over a long period. Here's why. The stock market's long-term returns are not distributed evenly across time. They cluster. They happen in short, violent bursts, usually during recoveries from crashes, and then they consolidate. If you miss the best days in the market, even by accident, the impact on your long-term return is severe. Between 1993 and 2023, the S&P 500 returned roughly 9.8% annually. Miss the 10 best trading days during that period? 10 days out of more than 7,000, and your return fell to 5.6%. Miss the 30 best days? 1.1% annually, barely beating inflation. The impossible thing about this is that those best days almost always happen right after the worst days, during the moments of maximum fear, when everything feels most broken. The crash and the recovery are inseparable. You cannot get one without risking the other. Market timers, people who move in and out based on economic signals, technical indicators, or gut feelings, are trying to be outside the market during the bad days while being inside during the good ones, and some of them succeed for a year or two. But there is no systematic, reproducible evidence that any investor, professional or amateur, consistently times the market correctly over decades. Not one. This is not a philosophical statement, it's an empirical one. If someone could consistently predict market direction, they would very quickly control all the money in the world. The fact that no one does is the evidence. What does work is time. Boring, uncomfortable, requires you to do almost nothing time. If you had invested $10,000 in the S&P 500 in 1980 and done absolutely nothing, no contributions, no rebalancing, no watching financial news, you would have approximately $1.1 million today. Not because the market is magic, because compounding is patient in a way that humans are not. The problem with time as a strategy is that it doesn't feel like a strategy. It feels like inaction. And inaction in the face of uncertainty, when markets are falling, when economists are predicting recession, when the news is uniformly terrible, feels irresponsible, foolish, like you should be doing something. That feeling is almost always wrong. The single most important portfolio decision most people will ever make is when to start, not which stocks to buy, not when to get out, when to start. And the second most important decision is when to stop getting in your own way. The uncomfortable math they don't show you. Let's put the 5 rules together and look at what they actually mean numerically over time. 2 investors, same age, same income, same starting capital, $25,000. They enter the market in the same year, in the same broad economic environment. Investor A follows the rules: diversified, low-cost index funds, consistent contributions through downturns, no panic selling, $500 a month for 30 years, roughly 9.5% annually after fees. At retirement, approximately $1.4 million. Investor B does what most people do. Same money, same contributions, but obsessively tracks his portfolio. Sells after bad years, chases hot sectors, pays 1.5% in annual fees for actively managed funds, averages 6.5% returns. At retirement, approximately $680,000. Same market, same time period, same monthly contributions. A $720,000 difference built entirely out of behaviors, fees, and emotional reactions to short-term events. The money Investor B left behind didn't disappear. It moved to someone else's account. Here's something worth sitting with. The rules we've discussed today are not secrets. They have been written about in academic journals, popular books, and financial research for more than 60 years. Benjamin Graham wrote about value and margin of safety in 1949. The data on investor behavior gaps has been public for decades. The math on compounding is not complicated. And yet, the financial industry generates over $600 billion in fees annually. Most of that money comes from activity, from transactions, from fund management, from the constant churn of trying to do better than the obvious thing. The obvious thing doesn't generate fees. The obvious thing is almost nobody's business model. This creates a structural misalignment that is worth understanding clearly. The people selling you financial products, almost all of them, benefit from your complexity, not from your simplicity. They benefit from your fear, not from your patience. The more you trade, the more you pay. The more you pay, the more they earn. This is not a conspiracy, it's just incentives, and understanding whose incentives are aligned with yours and whose aren't might be the most important financial skill you can develop. The 5 rules exist to protect you from the noise, from the churn, from the industry's best efforts to make something simple feel complicated so that complexity can be sold to you at a price. Harry Hoxley, the teacher from the beginning of this story, eventually recovered. He didn't recover by getting cleverer. He didn't find a better analyst or subscribe to a better newsletter. He just stopped. He put his remaining savings into a simple index fund, set up automatic contributions from his paycheck, and refused to look at his account more than once a quarter. By the time he retired, he had built something real, not spectacular, not hedge fund manager money, but real, substantial retirement funding wealth, built on the ruins of a speculation he almost never recovered from. The rules didn't require brilliance. They required patience. They required the willingness to be boring in a world that makes activity feel virtuous. The markets will crash again. They always do. Some new technology will look like a sure thing. Some pundit will explain very convincingly why this time is different. The confetti will fall when you buy the wrong stock at the wrong price for the wrong reasons. And somewhere in all of that noise, the boring, patient people will be doing what they always do: nothing, which is exactly the right amount. Here's the question I'll leave you with. If the rules are this simple and the evidence is this clear, why do you think most people still don't follow them? Think about that one carefully, because the answer might tell you more about your own investing future than any chart ever will. That's 5 rules. Not because 5 is a tidy number, because these 5, applied consistently over time, are what the evidence actually supports. Next week on Signal Mark Capital, we're going deeper into one of the most misunderstood concepts in all of investing: the difference between a business that's growing and a business that's compounding. They look identical from the outside. The financial outcomes are completely different. That one's worth your time. Here's what subscribing gets you, specifically, every week: 1 video, built around a single concept that changes how you think about money. Not how you feel about it in the moment, but how you actually make decisions with it over years. No alerts about daily price moves, no hot takes on whatever the market did this morning, just the frameworks, consistently, every week. Subscribe to Signal Mark Capital. Hit the notification bell so the algorithm actually shows it to you. And if this video gave you something useful, share it with one person who would benefit. Not for our numbers, because most people in your life are Harry Hoxsey, and they don't have to be. See you next week.